Hello everyone, welcome to Just Invest Today. And today we're going to be talking about the four main ideas of value investing for beginners. And guys, this goes back 80, 90 years to Ben Graham, the godfather of investing. And basically Warren Buffett took over the helm and he's teaching us the exact same thing he learned. And this is very important because this is the way to investing. If you want to be like a really successful investor, you should actually get to know value investing and kind of study it. And today, I'm going to teach you the four main ideas of value investing. So let's get into this video. So the first main principle, you have to look at stocks as a piece of ownership in the business, not just as a tradable security that you can just pass over to your friend or pass over to someone else in the market. You gotta look at it as a part ownership of the business. So what this means is that we gotta look at it like we are actually having our own business. We are like the sole people in the business. That's how you want to think about it, because when we put our money in the business and we anticipate the business to grow, we are to get those profits that generate out of the business, and because we're part owners in the business, right? So as the economy grows, as GDP grows, we're gonna actually get part of that growth if that business is growing with GDP or higher than GDP, right? And that's the concept we gotta like develop and gotta put in our heads, because even Monish Pabrai has switched his thinking. When he's thinking about buying stocks now, he thinks that he is the owner, he's the founder of the business. So when you think that way, you think about the business prospects. You don't think about the market and how it's trading up and down and wherever it's going. You think about what the business is doing because you own it. You only care about what the business is doing, how is it generating revenue, how is it going to grow into the future. And that's how we're supposed to look at businesses, and that's going to help us with the success of a business, because if we don't look at it that way, it makes us really like valuable to like all the random news that comes out about the business and all like the gossip going around. And if we don't look at it that way, we are very quick to sell our company and do stuff that's probably not beneficial for the business. So guys, this is how we gotta look at the business that we own. The stocks that we own, we gotta look at it as part owners in our business, and that's just gonna change our mindset and how we think about investing, and that's gonna allow us to hold these stocks for 5 to 10 years into the future. The second important concept, Mr. Market. So we understand that when we are investing in the market, we're trying to buy valuable businesses, and we also have to understand they're tradable securities. So when there's tradable securities, there's going to be a market for that. And when there's a market, there's bidding. So we got to look at Mr. Market as some drunken, psychotic guy that's just walking around and naming random prices. So when he's very optimistic, he has these high prices for all these businesses, right? And when he's not, when he's depressed, he has all these low prices for these businesses. And that's when we take advantage of Mr. Market, when he's very depressed and he doesn't like all these businesses and he wants to sell it at a low price. So we look at Mr. Market as a way to serve us. We look at Mr. Market as a service. We don't gotta pay attention to him when he's very optimistic selling these businesses at ridiculous prices. We only want to pay attention to him when he's selling these businesses at a very depressed price. So we gotta switch our mindset to that, and we just gotta look at Mr. Market as a service to us as value investors. So when we invest, we have part ownership into the company. And then later on, when we kind of need the money or whatever happens, something comes up, we can sell our part ownership in our business back to Mr. Market. So we're looking at Mr. Market just as a service, guys. Remember that, just as a service. Mr. Market is not our teacher. He's not accurate. The prices that he talks about, the prices that he says in the market is not accurate, right? So all the prices is not what we're supposed to be looking at. We look at that just to buy the business, to see if he's depressed and he's selling it at an attractive price. And if it's not, we ignore it. Mr. Market doesn't know the real value of the business. He's not our teacher. So our job as investors to actually find out what the intrinsic value of that business is. And what I mean by that, we want to know how much cash flows is this business going to generate from now till Judgment Day or now until forever. And then we discount that back till today. And then when we find the actual value of that real business, then we can look to Mr. Market to see if it's at our price or buy price, and we can buy it. If he's at that depressed state, if he's at that state that's giving us a good value. But if it's not, we ignore it. So that's how we look at Mr. Market, and make sure you have that concept in your mind if you want to become an successful value investor. The third main idea to value investing, margin of safety. And margin of safety is one of the most important concepts that you gotta realize in value investing, because this is how you actually make these huge returns and you don't get these huge losses. Remember about Warren Buffett is that his number one rule is don't lose money, and his second rule is remember rule number one, don't lose money. So how do we not lose money in the market? We don't lose money in the market by getting our huge margin of safety, 30 to 50%. So when we find that intrinsic value of that company, we want to get that margin of safety. And this is because we don't know the future. We can actually come to our assumptions about the business. We can actually predict, because all investing is about predicting the future. And we know the future is uncertain. Anything can happen. Stuff can go wrong with the business, right? So when you do that and you're trying to predict the future, we don't know what's going to happen. So we need that margin of safety in case anything happens. So if we are buying below what the business is actually worth, then if anything actually happens and any huge losses come, we don't lose big. We barely lose anything. But if our business does really good in the market, we get these huge gains. We get those huge appreciations in price. So that's why the margin of safety concept is so important to us. So the last main idea about value investing is circle of competence. So this is the one that Warren Buffett kind of founded, of the circle of competence, and this is a huge concept to have. So when we talk about circle of competence, we're talking about the businesses that we know. And when I talk about the businesses that we know, look at what you buy, look at what you do in your life, and see all the stuff that you know about. When we know about these businesses, we have these few advantages. And this is what's going to help us become and make a lot of money in the market. Because when we have that circle of competence and we understand the few businesses that we know, this is our advantage as retail investors, because we can actually see or we can kind of predict the future more accurately if we're seeing on the ground floor what this business can do and what this business can produce in the future, right? And so we have that insight, because as retail investors, our real advantages are being patient, or the ability to be a patient, and the ability to actually understand like few things that are going on around us. Let's say, for example, Snapchat. So, do you think the big Wall Street bankers would understand Snapchat more than us when we first got that application back in the day? Like, we would know that the Snapchat is becoming very popular in our circle because we're right there. We can understand it. We're seeing it develop. These big businesses, these big Wall Street firms, they wouldn't know about Snapchat like that unless they're on the ground level, seeing how popular it was becoming, seeing how many people were using it and telling other people to use it. So we could have had that little insight before people knew about it. So that's what we're talking about when we're talking about circle of competence. We're understanding the business and we have that kind of advantage. And then when it comes to circle of competence, we have to understand our boundaries, what we don't know, right? So like, for example, I don't know anything about insurance. So I don't go into insurance because I can't find any advantages. And if I can't find any advantages or stuff I know about insurance, I can't predict the future or what that company is going to do. And if you can't predict what that company is going to do 5 to 10 years, then we cannot come to an intrinsic value of that company. So that's very key, knowing your circle of competence, because guys, stuff will happen in the market. Your investment will drop 40, 50% if you're going to be investing for 10, 20 years. It's going to come a day where your investments drop 40%, 30%, 20%. Are you going to be scared? If you don't understand the business, psychologically, you're going to be scared and you're just going to sell that company for a loss because you don't understand what's going on in the business. You can't make future predictions or kind of get an assumption of at least an assumption of future predictions. You're just going to follow what everyone else is doing and then you're just going to come up with a loss. And that's not what we want to do. Because if our investment drops 40, 50% and we know that this company is strong, it's going to survive 5, 10 years, that provides us an opportunity to buy more shares at those low prices because we're confident in our predictions, we know the business, and we know how strong it is. So, circle of competence is an important concept. And these 4 ideas, you got to kind of implement in your mind. You got to remember them so you can able to make good value investing decisions into the future. So guys, if you like this video, can you please like it, subscribe to my channel, and I'll get back to you in the next video. Peace.